Stocks are not held for years, days or hours these days. On average, they are bought and sold in 22 seconds, as argued by eminent economist Michael Hudson, a Wall Street financial analyst, professor of economics at the University of Missouri, Kansas City, and author of several books. Of course, this statistic is skewed by the high-frequency trading of the largest hedge funds via the supercomputers located as close to Wall Street as possible, but the number is still frightening. In 22 seconds, I'm not even able to enter the name of the stock I want to buy into the platform and set the limit execution for it. If I calculate how long it takes me to buy one title, we are talking about 5 minutes, and in that time, other traders have already made 40 trades. Unbelievable. Welcome to my Invest with Jiri channel, where I cover long-term investing in stocks, ETFs and other assets. I discuss everything about money and investing here. You can find deeper stock analysis and more expert strategies for trading the financial markets on my Patreon, where I regularly contribute. In today's video, we'll look at 8 rules for buying stocks to hold them forever, so that you never have to sell the stocks and your relatives can inherit them from you. These are basic principles that every long-term investor should know and use. Let's take a look at the list of rules. Number 1. Focus on established brands in the market. Number 2. Observe how the company has behaved in the periods of growth, in periods of stagnation and during panic sales. Number 3. Look at history and see what stocks had the biggest percentage declines. Number 4. Have a strategy at hand for how to buy more stocks. Number 5. Take advantage of dollar cost averaging. Number 6. Focus on a maximum of 10 companies at a time. Number 7. Don't buy all stocks at once. Wait 14 days, a month, buy individually. And number 8. Don't be influenced by analysts' opinions. So let's go deeper. Focus on established brands in the market. With established brands, you have much higher probability of appreciation and company performance in the future. Established brands should have global reach and meet basic human needs. That's one of my long-standing rules, by the way, that I stick to, and for events that you want to keep forever, I think it makes sense. In contrast, startups with no or minimal history are a big risk. I'm talking about companies going public or those that have sales and earnings only on paper. Observe how the company has behaved in periods of growth, in periods of stagnation and during panic sales. If you watch how a stock has behaved in a growth, stagnant or declining market, you will find surprising things. For example, did you know that Coca-Cola stock rose during the market downturn and a subsequent recession in 2022 despite other titles? Recall that some titles like Netflix were down as much as -70%. By analyzing it, you get a better picture of the stock you hold in the context of the stock market, and that's not a bad thing at all. Look at history and see what stocks had the biggest percentage declines. Find out the biggest stock declines in history. If someone asks you if you would sell off a portfolio if it dropped 50% in value, you would probably answer, no, why? But in real situation where you are looking at your portfolio and it's falling day by day, you will probably act irrationally and sell off the stocks you are holding into cash to stop even bigger losses. However, if you have studied that the stock has historically dropped 50%, you are better prepared for this situation and you will potentially account for this drop. Have a strategy at hand for how to buy more stocks. Determine a simple strategy for how you will buy more stocks when they fall. Impulse buying and selling only feeds the broker. Set aside, for example, one half for buying according to the rules and the other half when there is a significant drop of say 10%. Devote an hour a month to analysis where you look at the markets and evaluate whether it is appropriate to buy more stocks. That's it. Long-term investing is not about impulsive buying, rather it's about patiently and over the long term putting cash into productive assets. Decreases and increases in value on the order of months do not play a significant role in your portfolio. A long-term portfolio takes years to decades to build. Take advantage of dollar cost averaging. Choose the monthly amount you want to invest in your chosen stocks and set up a standing order with your bank. If you have a larger amount you want to invest in the markets at one time, split it into 2 or 3 successive purchases, for example, increasing the position when it falls 5% or 10%. Focus on a maximum of 10 companies at a time. 10 stocks is about the maximum one can actively monitor and have a deeper understanding of. If you want to buy more stocks, then using ETFs rather than individual stocks is something to consider. As mentioned before, individual stocks should be known in depth, have an overall view of them, know their products, the historical development of the stock, the dividend paid and much more. It's not possible to keep track of that much information on dozens of titles. If we want to have an active overview and do something else as well. Don't buy all stocks at once. Wait 14 days, a month, buy individually. Each stock is affected by different fundamentals, and even if they are from the same sector, it doesn't mean they will move the same. For example, if Pfizer stock goes up significantly due to vaccine approval, that increase may not affect Moderna stock at all and vice versa. For this reason, it's better to wait for better price for individual stocks on the downside. Of course, some similarity in price movements for stocks in the same sector is obvious. Let's look at a chart of Coca-Cola and Pepsi. Don't be influenced by analysts' opinions. If you are one of the active people who are interested in the markets and read the news from the world of investing on a daily basis, don't be tempted by the good-looking analysis of the world's famous financial gurus and follow common sense. Stick to these principles, work on increasing the value of your portfolio, and you will surely get further than most mortals. There is really nothing complicated about choosing the right stocks to hold for the long term. The aforementioned list of recommendations can help you weather the sometimes significantly choppy waters of the financial market. Remember, there is no rush and you can build a portfolio over several years. The important thing is regularity and persistence. Have a good day, and if you enjoyed the video, give it a like, and lest I forget, invest wisely.